Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today I'm speaking with Justin Nielsen. Justin's the Market Research Director at Investors Business Daily. I've been on Justin's podcast, Investing with IBD, a couple times. I've always enjoyed our conversations. Also, I've done IBD Live, which is their morning live, sort of pre-market discussion. And I've always enjoyed chatting with Justin and the others at IBD during those conversations. Super fun to turn the tables a bit and be able to interview Justin. Usually he's interviewing me and asking me questions about technical analysis and market conditions. Today, I'm able to pick his brain about the William O'Neill methodology, about improving your market awareness, about generating ideas and how to monitor changes in market conditions, and his personal experiences working with the legendary Bill O'Neill. Please enjoy this interview with Justin Nielsen of IBD. Super excited to be speaking today with Justin Nielsen. Justin's the Market Research Director at Investors Business Daily. Justin, I've had such a blast going on your show, the Investing with IBD podcast, speaking with you on IBD Live. The tables are turned today, Nielsen, so I'm asking the questions. Right, exactly. You have to answer, so be prepared, all right?
Yeah, we'll see how I feel about this reciprocal arrangement here.
You did agree to this openly, right? You're not forced to come on the show. No, but honestly, listen, it's awesome to catch up with you, and I'm excited to have our viewers and our followers kind of benefit from some of your experiences, because I think you bring so much to the table, and I can tell that when we have conversations elsewhere. So listen, I'll start off by asking you this. When I've done work with you and the other IBD folks on your podcast on IBD Live, which is an absolute blast to do, three things stand out to me. Number one, you guys all have remarkably strong market awareness. So you always have a really good sense of what's happening around you as an investor. Second thing, you always seem to have great ideas. Like if I just randomly ask you, what do you like? You always have answers ready to go. And then the third thing, you're probably the nicest, kindest people I've worked with. And that's across. I haven't met a mean person at IBD. So people will have to assume that that's true. And they'll probably pick up on that. But let's talk about the other two. First off, market awareness. It strikes me when you and I speak, you generally just have a really solid sense of what's happening. What does your process look like for, following market conditions, appreciating changes in market conditions? Are there routines that have helped you kind of stay informed and stay aware? And what's that look like?
Yeah, no, I mean, it's funny because some of it is, of course, forced. It's kind of like my job to do that. So there's commentaries. There's commentaries that I'm writing and things like that. And so you're always trying to like poke around, and sometimes it's just kind of being open to discovery. And that's kind of the neat things about the stock market, right? Is that there's still I've been doing this for 27 years or whatever. And there's still like kind of that discovery every now and then where it's like, oh, this is a little different, or this is interesting. So sometimes poking around, and we do a lot of analysis of the indexes themselves. But, as we've learned, because of the heavy weighting of the Magnificent Seven, sometimes that's not enough. You have to look at other metrics as well, whether it's equal weighted indexes to get a better sense of breadth, or even, going down to the sector level. One thing is to just like look at the sectors, the 11 sector spiders. But even that became not enough. I started looking at the equal weighted sector spiders too. And so you have all of these different levers and places to search. And I guess that's what makes it interesting, right? You're, especially with the ETF side, you're always faced with these new products that are kind of taking a different take on it. And you read about it and it's like, oh yeah, that makes sense. Or you find an ETF that's kind of looking at, specific sectors, new sectors, or even the growth of the single stock ETFs. And it's just, there's so much change that's happening, and, kind of delving into it is a lot of fun. And so I guess that's part of it, just kind of being curious.
It's so I love that. That curiosity, I think, is gold. I think that's 100% right. And I remember, I forget who it was, one of the early financial bloggers, like a Barry Ritholtz type of person,
Mm-hmm.
years ago, said that doing a daily blog was helpful for him because it just forced him to
Yeah.
always have an articulate thing. And I found that doing a market recap show, and it sounds like you found like that the same. What, if I can ask, what do you have, like a morning coffee routine? What does it look like when you first look at the markets? Is there a certain set of things that you hit every day? Is it more just a let's see how the day unfolds, or do you have a structure to that beginning to the day that helps you understand where things are getting started?
Well, a lot of times I have the benefit of, we have our IBD Live daily show. And
Yeah.
so, one of the things I start with is kind of the pre-show, right? And so we're kind of
Mm,
chatting ahead of time. And of course, I have what I call my morning radar. And it's just kind of
mm,
a look at the futures markets. I again have the sectors up there. I have a few different lists that I kind of use to gauge what's happening, and I'll just sort by in the pre-market what's up a lot, what's down a lot, what's looking at some of those charts. But it does give me a sense of, okay, what's happening. And I'll be honest, I kind of do that before I look at the news, so
mm,
that again sometimes leads me to a question like, oh, I'm noticing a lot of stocks or this sector doing something, what's going on? And then I kind of have a basis for where to look for the answer to the question, instead of
mm.
just taking this barrage of information and not knowing what's relevant or not. I kind of let
Yeah.
the market tell me a little bit. Oh, this is what's relevant. So this is what you should pay attention to.
It's so funny because so many people completely flip that, right? We start with a narrative, then we just start trying to look for things to either support or refute that narrative. And what you're
Right.
saying, which I think is fantastic, is look at the evidence. Let's see what the information is telling us. And in my case, certainly, and I think for yours as well, the charts and where they're showing some potential opportunities. So give us a taste here. I mean, I know you're always publishing and doing a lot of videos with IBD Live, with your podcast and everything. As you're doing that routine recently, what are some of the, I guess, questions that are coming up as you're reviewing the evidence? What are the questions that are raised when you're looking at the charts these days, early March, as we're recording this?
Yeah. Well, I mean, uh, a lot of it is what the heck is going on, right? Because
Open question, right?
yes, yeah. I mean, because it's things change so much on a day-to-day basis. And
Yeah.
I mean, I'll just be honest, I haven't had a great time since October. It's been basically a drawdown period for me. I think I peaked my equity curve September 22nd, and I'm still kind of working on trying to get myself back to new highs. So,
Yeah.
and I think again, it's been a tricky market in that regard, because you've had the major indexes going sideways for the most part, but there have been some really fascinating stocks, right? So there's this temptation, like, oh, it's not where you would want to be completely removed from the market and in cash when you see things like the data storage stocks going, or even, I mean, for a long time, the semiconductors were holding up so well. And then,
Yeah.
not to mention, you had the equal weighted indexes that were saying, well, basically the average stock was fine. So as
Mm,
long as you weren't, piled into meta platforms and the Magnificent Seven, which again worked great in 2023 and 2024,
yeah.
but not so much at the end of 2025 and to start 2026. So again, sometimes it's being kind of aware of your own faults, and having some humility and saying, okay, yeah, I'm not doing well right now, and having that ability to do some introspection and say why, and kind of identify where things are off for you a little bit. And certainly for
Mm,
me, I think I traded more than I should have during that period, because it was it just always seemed like it was just about to go. Now, I wouldn't be shorting either, because I think if
mm,
I had if I had done myself the huge disservice by trying to shorten this market, I think I could have done more damage. Because the way that sideways markets work a lot of times is, if you buy on strength, which is a lot of what the IBD methodology is about, you buy on strength, you buy breakouts.
yeah.
In this market, it's been kind of a lot of those once they break out, they come off the bottom, and once they break out, the move is kind of done, and they start basing again. And on the flip side, where I've been shaken out of a lot of stocks is kind of near the lows, right? I have to honor my stops because I don't want my capital drawdown to get too excessive. I don't want my hold to get too deep. So I have to honor my stops. And sometimes that means I'm getting out right at the bottom, before it turns. And I mean, we've seen that in the NASDAQ and the S&P 500. It keeps on getting to a certain level, and the buyers just really come in, whether or not they, think that, again, there's still a lot of optimism. Even looking at a chart, I was stunned by this. This is something that, we are certainly in the middle of a huge amount of uncertainty with Iran, but if you look at the chart over the last few months, where did the Iran war start? Usually you can see an event on the chart, right?
Yeah.
It's not clear where it started. I mean, unless you know where it started, you can't identify it on the chart because it just looks like how we've been the last few months.
Yeah, honestly, it's like how much particularly the equity markets, how much has changed in the last week and a half versus prior to after. I mean, at this point, not a ton, right? You had mentioned, I mean, there was just a ton of investment wisdom in a number of things that you just said there, Justin. But one of them, you've alluded a number of times to the fact that the equal weighted version of the S&P 500, 100% correct, has been remarkably strong in the last couple of months, even though the cap weighted S&P has been flat. You also mentioned buyers coming in, and we've seen that sort of the proverbial dip buyers appear to be coming in, which is sort of providing this support for the S&P. What kind of tools or techniques would you use to determine that that's no longer the case? Because I feel like what's been holding this market up has been those willing buyers buying in on weakness. What would you see? Is it a break of a certain level on major indexes, or is it deeper looking at volume or some other metric that would help you say, okay, the dip buyers are no longer showing up. Now we need to start worrying about things. Does that make sense?
Yeah. And I guess, I'm going to completely contradict what I just said, because the Iran war did show up on the equal weighted indexes, right? That's where things kind of started falling apart. And on the international side, had a lot of strength there in international stocks. And, when things started, really coming to a head, and the conflict began, then you could kind of see that. But again, I think there's that recognition of where the support is coming in, where the resistance is coming in, and sometimes it's just as simple as drawing lines, right? It becomes kind of obvious. It's like, oh, okay, it hit this level. Oh, it hit that level again. Let me start just drawing a line where those points are. And a lot of times what I find is being very willing to draw that line to the left, looking to the left and seeing, okay, where are we right now? And what have we done in that area before can be very instructive. And again, you can't hang your hat on that and say, well, it's happened this many times before, and so of course it will happen again. You always have to be ready for, kind of the John Wooden idea. You fake once, you fake, twice, and then you go the other way. So you have to be ready for that. But at the same time, it can give you a sense of, okay, I know where I'm wrong. I know where it's acting different this time. So, just again, drawing lines. And that's the great thing about technical analysis. I don't have to tell you, you got your fancy CMT there. But yeah, that's one of the great things where sometimes it's just that simple, drawing lines. And that's why price and volume at the end of the day is, such a great indicator, just by itself.
It's so funny. My 10-year-old son, Henry, I was getting him ready for school today, and I was doing some work. So I had my laptop open. I was looking at Bitcoin, and my son kind of turned over and he was like, "What's that?" And I'm like, "Well, this is Bitcoin. What do you think is happening?" He's like, "Well, it's going down." I'm like, and then I brought up, he's like, "What's GLD?" I'm like, "That's gold. Why don't you bring that up?" And he's like, "Well, that's going up." I'm like, "All right, which one would you rather own, gold?" He's like, "I'd rather own gold." I'm like, You're now a medium level technical analyst right there. You're doing it, Henry. That's awesome. So yeah, it does. We don't have to overcomplicate it, I don't think. Wait, so tell me this, and so when we're thinking about the broader market conditions, the cap weighted indexes have been relatively static. The equal weighted index is starting to turn lower a little bit here in the last week or two. I know the CANSLIM methodology, which I know you're well aware of. That M stands for market, right? Market direction. So if the major averages are in a consolidation phase, or if they're in a clear downtrend or in a clear uptrend, how does that market direction inform your stock picking or form your analysis of individual names? Are they separate? Are they related? And how?
Mm-hmm. Well, we always kind of, went off the belief that 3 out of 4 stocks will follow the general market. Of course, the issue now is that, well, what's the general market? Is it the NASDAQ? Is it your equal weighted S&P 500, or is it the S&P 500 or the Russell 1000, or the Russell 2000? It really kind of depends on your market. And that's where I think this has gotten trickier, because uptrends are easy, right? Stocks are going up, you feel like a genius, and the birds are singing, and everything's happy. Downtrends, I think, are easy too, because when things kind of get so bad, I think it's easier to say, oh, you know what? I'm going to take my toys and go home. I don't want to play this game. This game's not fun. And it's easy to stay in cash. For instance, last year, and like around February 21st, I basically went to cash, and I didn't get back into the market until the end of April. There just wasn't any reason to. It just was in a downtrend, and the volatility, once it did start coming up, the volatility was so great. I'm like, I'm not smart enough to know what's happening here. I don't have an edge. And if I don't have an edge, why am I going to try and force myself into a trade where the risks are potentially much larger than my rewards? So that's not the way you're supposed to do it. So yeah, I think downtrends are easy. Sideways is the tough one, right? Because we're always being very aware of when a turn is potentially happening. But with sideways markets, you see a lot of turns, but you don't see a lot of trends, and so, or the trends can be very short. And it's very difficult to establish a position and kind of nurture that position when you're not getting cushion on it. That's one of the things that I feel kind of makes, I like getting the feedback from the market. I like for the market to tell me that I'm a good boy and give me a treat, and the way it does that is my stock goes up. And if my stock doesn't go up, then I feel like I'm doing something wrong, because my expectation was for it to go up. And if it doesn't, then what's happening? And I just usually don't necessarily throw out my thesis. I said, I can be right on this stock, but my timing might be off. So I have to make that decision of how patient I want to be, and where I'm going to not only put my stop for capital loss, but I also sometimes will put a time stop. Like if this doesn't move in a given period of time, well, then my thesis was wrong. At least my timing was wrong. And so I need to kind of correct that. And I think the problem here with the sideways market has been, again, you have a lot of these stocks that were moving. You had your average stock moving, but you also had a lot of cross currents. The things that were moving aren't necessarily the things that we were paying as much attention to. I certainly, in an AI boom, I wouldn't have pegged the consumer staples as being the leader, right? That's not where we were thinking. And even to a degree, there were some areas where it didn't make sense at first. Like, AI is, the buzzword. Why are utilities, doing so well? And it was like, oh, until you kind of, again, this is where the chart leads to the question, like, oh, the utilities are moving. Why? Oh, the power that they're providing for the AI and the chips. And, same thing with the air conditioning and HVAC systems. Well, that didn't make sense at the outset in my mind, but the chart's moving, something's happening. I've got to figure out what. Oh, okay, this is what's going on. But yeah, certainly, again, getting back to your original question, which was, I think, 20 minutes ago, the sideways market is certainly, again, I think one of the more challenging things. And so then you have to kind of determine, okay, what rules do I have to put in here to protect myself from myself, and that can be, I'm not going to do more. I'm not going to get more heavily invested until I meet these thresholds, or what have you. But I think doing something in order to protect yourself from your own self is important, at least for me, because I can be my worst saboteur. So I have to put guardrails in.
Justin, that was awesome. What rules do I have to put in place to save myself from myself? That might go on the quote wall over here. I think that's a solid one. So my next question, the short question is, how do you know all this stuff? And the somewhat longer question is, where did you sort of, embrace, learn, and understand and internalize the O'Neill methodology to the point that you're able to speak so eloquently about it today? What were those formative years of being introduced to this way of approaching market conditions and identifying opportunities?
Sometimes pure chance is much better than best laid plans. So the reality is, a lot of people laugh at this, but I'm an anthropology major, and so this is certainly not the path I thought I was going in. I planned on being a teacher. My mom was a teacher. My dad was a teacher. My sister's a teacher. My aunt was a teacher. There's a lot of teachers. So, that was my plan. And I just wanted to do something in the business world for a year and then go and get my credential and, go about my life. But again, the curiosity factor. I didn't know anything about the market when I took a customer service job that, again, this was a temp agency that placed me and said, well, I don't know if you're going to want to get up at 6 a.m. They do East Coast hours. I'm like, gosh, I don't know either. But you know what? I want to learn about the stock market. So yeah, I'll do it. And I was given How to Make Money in Stocks by William O'Neill. Once I got hired, it was the red book, the second edition.
Yeah.
I read it and I'm like, I want to learn more about this. I didn't even know what the Dow Jones Industrial Average was. And I didn't know when that moved up 5 points, what that meant. What's a point? What is that in dollars? So I learned a lot. And then I became part of an education crew, so again, I kind of was doing education. And then after the 1 year, I again was doing the education thing, and I wanted to learn a little bit more. And then Bill O'Neill, the founder of Investors Business Daily, who had written that book that I wrote, that I read, he said, hey, I need a new assistant. Would you mind doing it? I was working on some projects, and I got his attention, got his son's attention, who was publisher of IBD at the time, and then I was his assistant for 15 years, and that was great because I got to see him trade. So I could see, I had a front row seat to, this is what works, because he was one of the most successful traders ever. And I just got a front row seat to see what works and to ask him questions. And every now and then he would ask me questions, and then he'd chuckle at some of my answers and say, you sweet, innocent kid, kind of thing. And then he'd tell me the way it really works. So I had the benefit of kind of learning from a master, and although we didn't necessarily speak daily on the market, we touched base often enough. I, sat right outside his office for a long time, and then did special projects and traveled with him. I built his presentations, and, that's how I started speaking myself, because after a while, they're like, well, you know this story, right? And I'm like, oh yeah, Bill O'Neill, he bought, Chrysler in 1962 after the Cuban Missile Crisis at 57 and 7/8, and I just knew this stuff because I had heard the stories so often. So they figured, well, if you know the stories well enough, you can probably talk semi-intelligently about it. But I also, Bill remained curious until he, the entire time I was working with him, he was always like looking for ways to be better, and he had no reason to be better. He had done a very successful career. He was doing very well on the market. He didn't need to improve, but he was always looking at what's changing, what else is interesting. And the fascinating part is, as much as we talk about how things are different, it's remarkable how much things are the same. How when you look at old charts, it's remarkable how similar. You look at a chart from 100 years ago, or even markets from 100 years ago, and how similar they look to today. So while our technology has changed, and there's a lot of changes that have happened with the environment and algos and everything like that, human psychology hasn't really changed. And so now I'm back to my anthropology major, and seeing, oh yeah, that's something I learned in anthropology. We do not change quickly. That's just not
Yeah.
the way it works. Our brains kind of are still using a lot of things that got hardwired in, thousands and thousands of years ago. So it does make sense that a lot of those things that worked 100 years ago still work today.
That's so awesome. So I studied music and psychology as an undergrad, Justin. So we have a liberal arts market analyst club starting here today. We've got 2 members. We'll look for more here. But it's so funny
Yeah,
though. But I think, go ahead.
well, I was just going to say I'm fascinated by how many musicians are
Yes.
are good at trading. I mean, like it's kind of interesting. I want to see, so maybe you can use your psychology major to figure out what that connection is, so
it's true, and it's funny. There are some really fascinating parallels. There's a very mathematical component to music, which a lot of people don't realize. So it's all about the more statistical parts of technical analysis kind of scratch that itch that I had before. But no, I think what I'm not surprised to hear of you studying anthropology. I'm not surprised to hear of you sort of leaning toward education, because that comes out, I think, very well in how you present yourself and how you present the markets, I think, so clearly to people. So that methodology that you then had a firsthand experience with, like this CANSLIM methodology, I can't imagine there are people that aren't familiar with what those letters represent. But for those that are less familiar, if you could just help us understand, out of those 7 different sort of factors that you're considering, which of those letters would you say is most important right now in March of 2026 as you're evaluating companies, and why? Or are they all equally important? Is that one of those things that hasn't really changed even though market conditions have evolved?
Yeah, that's a real interesting question, because sometimes you will see some shifts. I mean,
Mm,
one of the major components, of course, is earnings. Not
yeah.
only your most recent earnings, but also kind of your long-term earnings, and we also look at the stability of those earnings. So those are a lot of things that I think will really go into these longer-term leaders, right? The ones that you see that it's not just a move of a month, it's moves of years that they can
Mm,
do, and that just seem to keep going year after year. And again, a lot of that is fueled by earnings. But at the end of the day, I think one of the more important parts of all of this is the recognition of just kind of following the money, right?
mm,
So, we used to talk about, knowing where the institutions were buying and how they have their footprints. But certainly kind of understanding supply, demand, and, being able to recognize when that demand is happening, I think is incredibly important. And that's why we do focus on the strength. We focus on leadership, not the laggards. And it's also why we will, use both fundamentals and technicals. That was something that, again, remember when William O'Neill, when he was coming up as a stockbroker, the fundamental folks and the technical folks, they were in 2 different schools, and that was, yeah, that was not a co-ed situation where they mingled at parties. You were either one or the other, but he really saw the value of both, because he recognized, okay, charts really help with your timing, but you have to start with a company that has something. And so,
mm,
uh, you know, again, a lot of times I will start with the chart, but having some understanding of what the company does, what is it that's new, does help you with conviction in the stock to determine, oh, this is something that I want to make sure I hold on to for a little bit longer. Now, some stocks I'm only trading off the chart.
yeah.
Gold, what, I'm not smart enough to know all the economies of scale for the for the gold miners and what's happening there. But yeah, I don't know there in terms of long-term economic stuff, but I'll make a trade there. But something else where, oh, like data storage, oh, there's shortages here, there's some real potential for growth, or you see how the earnings of Nvidia just not just beat, but clobber estimates, and the stock is going up at such a rapid pace, but the PE ratio is staying the same basically, because every earnings report comes out and it's like, oh, they're the earnings are keeping pace with the phenomenal price growth. So those, just identifying those things. And again, it's about kind of being curious, looking under stones, and seeing what you discover. But at the same time, I think there's so much information out there. You have to be careful of not letting yourself deviate too far from looking at the price, price itself, because it can be very easy to speculate too much. And I think that's what's going on with AI, right? There's a lot of speculation of what could happen in the future. And there's a lot of noise in terms of, oh, this camp is saying this is going to be the biggest change, life altering. The stock opportunities are endless. It's like the internet all over again. And there's the others that are saying, oh, this can really crash the market. And, this disruption can, cause a lot of dislocations. And we've gone up so much, we're due for a correction. So at the end of the day, you have to say, okay, look, those are all opinions. The market is going to kind of siphon through all of those and give me, where the equilibrium lies, at least for now.
Yeah.
But that can change, as we've seen a lot.
I'm glad I'm glad you shared some of the insights about William O'Neill kind of combining the fundamental and the technical, because I've seen that sort of fusion approach in a number of places. But that book, How to Make Money in Stocks, was, I think for me, the first introduction to how you would marry those disciplines in a meaningful way, and how, when I was sort of we started in the industry around the same time. I was right in 2000. And okay. I remember, sort of this, there was the
what an interesting time to start.
There's the fundamentals and the technicals, and you would never cross those streams, right? I mean, they were their own disciplines. And, here's William O'Neill talking about how he combines those. And I remember his son, William O'Neill received an award from the CMT Association years ago. And his son shared some really cool images of, William O'Neill's hand charts, with all the notes, I'm just like covered in notes. And it was just such a beautiful way of representing that kind of fusion approach, between the two. Just to finish off here. So I'd love to just wrap with this. I mean, you had, I think, just a rare opportunity to witness one of the masters, the stock market masters, practicing his craft. And then you've had the ability to apply that methodology now with great success, I think, in your own right. What's one of the O'Neill maxim or lesson that you think is most relevant for investors to keep in mind here in March of 2026? What helps you make sense of what we're experiencing here today? What's going to serve investors most well?
Flexibility, I think. The reality is you can't. It's okay to build a thesis, but when you were on my podcast not that long ago, you brought up confirmation bias, and I think you have to really fight that search for confirmation of your thesis and ignoring the evidence that you're wrong. Always be very willing to look at those lines in the sand. Where do you know that you're wrong? Where do you know that this isn't playing out the way you thought? And again, you could be right long term, but there's the old saying about sometimes you can't be solvent for as long as it takes for you to be right. So and that was one of the cases in the 90s, right? There were so many people that recognized, oh yeah, this is a bubble, and unfortunately, if they shorted, they got their hands handed to them because they were just a little bit too early. So I think, again, you have to have that flexibility of knowing when you're wrong, and even not getting too bearish either, because you can really, especially if you watch the news, you can really kind of get into a lot of despair that things will never turn around, or that the stock market is never going to be the same again. And I just think that there's always opportunities. And so you just have to be willing to look for them, be flexible at changing your mind as new evidence comes in. And one of the things I learned the most from Bill is that he would absolutely make a stand. He was giving advice to institutional investors, but no matter what he said yesterday, he was willing to change his mind today if things were different. It was just that simple.
I love this. This was awesome, Justin. Be flexible, be humble. Think about what rules you need to put in place to save yourself from yourself. Don't force yourself into a trade. There are a lot of quotable moments in today's discussion, and I thank you for that. I appreciate everything that you're doing. Thanks for including me in some of the great stuff happening at IBD, but thanks for coming on the show today and sharing your insights with all of us.
My pleasure. It's always great talking to you, Dave. I mean, we can throw the camera on or we can just do it ourselves anytime. Either way. Time, Justin. Thanks there have been some times when I've had you on the pre-show and I'm like, why didn't we just put the camera on? It was a great conversation. So yeah, it's always fun, and we'll do it again, I'm sure.
Sounds good. Hope you enjoy that interview with Justin Nielsen. Justin is a genuinely wonderful human being. What a nice guy to chat with, and fantastic experiences. And again, I mean, so many people have learned about and apply William O'Neill's methodology. Justin had the rare opportunity to work directly with Bill for a number of years and have a front row seat for one of the master practitioners, working his craft, which is pretty awesome. So many great quotable moments in that discussion. I love that idea about don't force yourself into a trade, right? How often does that happen, particularly when the markets are sideways? I think Justin spoke right when he said, uptrends are fairly easy. Downtrends are pretty easy. And I 100% found that, right? Mid-2025, pretty easy market. Mid-2024, pretty easy market. Market's in an uptrend. The things that should be working are kind of working. Things make sense. Big downdrafts like we saw in 2022 in a lot of ways are pretty easy too, because it's so easily, clearly a risk-off environment. You just need to get out of the way and get in cash, get defensive. Transitions, inflection points, consolidation periods, sideways markets, that's where things are a little more challenging. But I think to Justin's point, don't force yourself into a trade. I always tell my son, wait for the good opportunities on the soccer pitch. We need to do the same thing with our portfolios. I really love, what rules do I need to put in place to save myself from myself? In my previous conversations with Justin, we talked about behavioral biases. We talked about how charting and technical analysis helps you apply discipline, helps you be more mindful about the evidence and focus more on the evidence the markets provide back to us in the form of price action, less on our emotions, right? We want an evidence-based investment process, not an emotion-based investment process. And I think thinking of rules to put in place, thinking about sell rules, stop losses, money management approaches, position sizing, all of those rules that help you, stay focused on the evidence and don't react or overreact to our emotional state, I think is a brilliant way of thinking about it. His final comments there, be flexible. He said earlier in the conversation to be humble. That idea of humility has come up with a number of my conversations on the podcast. I found that top investors have a great personal awareness. They know what they're good at. They know what they're not good at. It's not that they're good at everything. They've just found ways to benefit and profit from their strengths, and they've surrounded themselves with systems, resources, and tools to help minimize their weaknesses or help adjust for and adapt to some of their perceived weaknesses. So I think humility is spot on, and flexibility, right? I feel like the gravestone of a lot of failed investors has something along the lines of they stayed with what used to work instead of adapting to what starts to work, right? I would argue we're very much in one of those transitional environments where the trade for 2025 is certainly not appearing to be the trade for 2026. It appears to be a very different environment. We're seeing leadership rotations. We're seeing market conditions evolve. Whether or not we get some major corrective move here going, from the first quarter into the second quarter, undeniably we're seeing leadership rotation. So sticking with the themes and approaches and indeed the stocks that worked is a great way to do well until conditions change. Why don't we improve our market awareness and make sure we recognize those changing conditions? We touched a lot on the CANSLIM methodology. I would encourage you to check out Justin Nielsen's work over at IBD, his podcast, Investing with IBD. Besides my episodes, I've been on there a couple times. It's been a lot of fun, but his conversations are fantastic. He has the ability to draw some really good insights from a lot of different market practitioners. And I've been an IBD reader back when it was a daily print publication when I was just getting started in New York. And I followed their work and still subscribe to their website so I can follow their insights. And I've used tools like Market Surge before. I would encourage you to check out their capabilities because I find they are fantastic at improving your market awareness. Thanks again to Justin Nielsen of IBD and the team there for doing fantastic work to educate and empower individual investors. And I appreciate him coming on the show today. By the way, if you want to learn more about some of the technical analysis tools that were implied by this conversation, some of the ways that we can use our technical analysis capabilities to appreciate market evidence, to improve our market awareness, and get out of our own way, save ourselves from ourselves, as Justin put it. If you want to learn more about those technical analysis tools, our Market Misbehavior Premium membership could be a great way for you to upgrade your own decision-making here in 2026. 3 great benefits to the premium membership. First off, we'll teach you all about technical analysis and behavioral finance through our virtual courses. Second, we will keep you informed and updated on what's happening in the markets with our member-only reports like our weekly flight plan and our monthly chart review. Finally, you'll have full and immediate access to our member community where you can ask questions, where you can learn from other like-minded investors. I'll be there all along the way to help you make sense of these market conditions and address your questions. All of that, more information can be found at marketmisbehavior.com/premium. Don't forget to use the code podcast at checkout for 30% off your first 12 months on any plan. That'll do it for today. Thanks so much for joining me here today on the Market Misbehavior Podcast. My name is Dave Keller, reminding you it's always a good time to own good charts. Take care, folks.